Welcome, everybody. Thank you for joining, and give the guys a hand, please. Thank you. So Steve, you've been investing in early stage technology companies. You invested in Uber pretty early, didn't you?
Collaborative invested in Lyft.
In Lyft? Yeah. Oh, didn't you? No, so there we go. Look at me, not knowing. Lyft, Uber. I like Lyft better, actually.
Me too.
It's a lot cheaper. So tell us about you, your firm, and some of the, a little background for the audience, please.
Sure. So my background is I've been a finance professor for the last decade at University of Oregon. Go Ducks. And so I've spent a lot of time thinking and writing about securities even before I was sort of involved in crypto and blockchain. And I think the story with Collaborative Fund is that they were one of the original peer-to-peer investors. So they invested in Lyft and Quora and Reddit and sort of anything that was facilitating peer-to-peer interaction starting about a decade ago. And so in probably 2016, people started sending them deal flow around blockchain and around crypto. And they said, you guys are going to love this stuff. It's like peer-to-peer supercharged in some ways. And so the founder of Collaborative was an old friend. He knew that I was teaching and I was researching these things at the university. And he said, hey, would you look at some of these deals with us? So we invested out of the main fund for a couple of years. Eventually, it became clear that the space was expanding so fast in so many different directions along regulated channels, along unregulated channels, into commodities, into real assets, that we said we need a separate fund and we need a team that's thinking about this all day, every day. And so we spun up this separate vehicle called Collab+Currency. And so that's the fund I manage now. We closed our first fund in 2018. We're now on our second fund. We're about $500 million in AUM, entirely invested in crypto and blockchain. That is our only mandate. And of course, as Dave mentioned, Vertalo is one of the positions. So I've been passionate about this idea of traditional assets on chain and regulated assets on chain for a long time. And thanks for having me.
It's great to have you, Steve. Hey, Tara.
Hey there, Dave.
What's going on?
Just hanging out.
Cool. So tell us about Alto IRA and the journey you all have taken, and your different approach than these folks here, because you're an alternative to this kind of vehicle, aren't you?
Yeah, so Alto IRA enables individuals to use funds in their retirement accounts to invest into private markets and alternative assets. And that includes traditional structures like a Reg D, that's investing into digital assets on the back end. It also includes directly buying and selling crypto through our crypto IRA. And now we're venturing into supporting securitized tokens, right? So security tokens and other digital assets that require walleting infrastructure and some support from our friends at Vertalo and others. I think what's so exciting about this is if you look across the households here in the US, 70% of the funds they have available to invest are in their retirement accounts. And for most folks, that means that they are inaccessible in order to be able to invest. And so we're really in the business of helping that individual investor be able to get access to some of the more exciting private market opportunities by unlocking their largest wallet. And we work with incredible partners across the ecosystem, issuers, founders, any entity raising capital to help them be able to accept IRA investments from their investors.
It's fantastic. When I went to their site and I saw all of the partners that Alto has, I was stunned. And all the ARCA, Anthony, you all are partners with these guys, right? It's fantastic. So you can use Alto to get into investments that you might not have even known existed. And they make a clear path to that. One of the hardest things about investing in private companies and the assets that we work on here is actually just discovery. And through Alto, I think Alto reduces the friction in discovery. And then also, when Gautam, my partner and co-founder, wanted to put more money into Vertalo several years ago, he had all of his IRA at Wells Fargo, and it took us, Gautam, how long did it take for us to make that investment through Wells Fargo?
8 weeks.
Yeah.
8 weeks. His money, okay? And I had to fill out in pen multiple forms. I had to fax things, okay? We had to talk to people on the phone over and over again. And then we had to explain what the company did. It was the most painful process that I've ever gone through in getting any investment. I mean, even from a VC, sometimes it's hard to actually get them to send the wire, okay? What, Steve? You don't know
Not
about
me.
that? And then, so 8 weeks. Another partner here, Dealbox, John. John, you worked with Alto most recently to facilitate an investment in your company, right?
Yes.
How'd that go?
Oh, it was amazing. Maybe 48 hours worth of work, a couple clicks, 10 minutes for the investor.
Yeah, it's fantastic. So, thank you for the service you provide, and we'll grill you with fewer softballs in just a minute.
No, that sounds great. And seriously, y'all, find us. There's a bunch of Altonians, as we call ourselves here, and we really see ourselves as being able to unlock capital for investment. We are Switzerland. We're really just here to be able to help those capital raisers be able to raise capital by, again, unlocking the largest wallet for an investor, which is their retirement account.
So, Alex, we've known each other now for several years. We met in LA.
True.
I think in July, or was it May 2019?
18 or 17,
2018,
17.
right?
Yeah, we're old, man. It's
We're
kinda-
old out.
yeah.
Look at this. I mean, Alex and I are like 35 years old.
Yeah.
I mean,
Yeah,
look what this has done to us.
exactly. I
So-
then had white hair, and you had hair.
I did. So, tell us a little bit about you and about 7cc. And
Yeah, so thank you for inviting us. It's a pleasure to be here. My name is Alex Nascimento. I was teaching and making investments in general tech in 2016, and then met some of the folks that were playing around with MetaMask and Ethereum. Started making investments in 17 in coins, not anything special. As we all know, the market grew tremendously. At that point, UCLA and a bunch of faculty there that are much more senior than I am decided that UCLA should have a blockchain initiative. But at that point, frankly, nobody knew what blockchain was. So we started the UCLA Blockchain Lab in 2017, and I was writing the curriculum, but there was actually no books, right? So we wrote a book called The STO Financial Revolution, which was very pushed by the higher powers of UCLA when the SEC said no more coins. So no more coins means that now we need to teach this from a regulated point of view. So that journey took us to develop 7cc, which we do two things. We do asset management and tokenization of assets mainly in Latin America. And we're now next month launching a fund of funds. So some of the funds out here we've spoken with, and we'll look forward to chatting more with you.
it's great to have you here. If you haven't had a chance to corner Alex and check out his book, I recommend you do that. Alex has a particularly kind of longitudinal view, like Steve has, and having seen this company, this community evolve, and I can imagine that more editions of the book as this evolves, right?
Yeah, we're in the third edition now, going to the fourth. And thanks for your contribution to the book.
My pleasure. So Mike, you're with Wave Financial, and boy, so interesting that you are on both sides of this equation. So Wave Financial is an RIA, and among other things, they create products, and they advise, they place, and they have money placed into them by people who are interested in digital assets. So
That's right.
tell us a little bit about you and some more about Wave.
Thank you. And coincidentally, I am 35 and have gray hair, so just checking all the boxes. Hi, everyone. My name is Mike Jones, Head of Business Development at Wave Financial. As Dave alluded to, we are kind of sitting on both sides of the equation. The firm really started out attacking two sides of this business. One being working with protocols, working with miners, any kind of player in the space that is sitting on really a singular exposure. For a Bitcoin miner, for example, that's Bitcoin, and that comes with a lot of risk as well. They turn to Wave for its 24/7 trading capabilities, its ability to get into the derivatives market, maximize yield, minimize risk, and really be an advisor to the balance sheet. And that has happened for actual cryptocurrency, protocols as well. On the flip side, Dave Seymour, our CEO and founder, also has been in the venture game for quite a while, and in crypto specifically for the better part of a half decade now, investing in the blockchain technology. We have two existing funds that do that. One is focused kind of blockchain agnostic across the board, and the other is really focused on the Cardano ecosystem, where we have a good relationship with that particular protocol and are really building out the ecosystem by investing in the technology that will really fuel that technology into the future. From that point, really working on these two kind of extremes when it comes to the complexity and the navigation of the financial markets, really have drilled down to create a set of funds that are accessible to anyone that is an accredited investor. We have two access products. We have a top 5 cryptocurrency index style fund that gets you exposure to about 80% of the market. We have a Bitcoin income and growth fund, which buys Bitcoin on behalf of the client. We write covered calls on Bitcoin and can generate a target yield of about 18% a year just by kind of harvesting the volatility that exists in that marketplace. And then really the last leg of our journey in kind of experimenting with tokenization more recently has been with two funds that are kind of private equity structures that invest in Kentucky Fine Whiskey, actually, and tokenize those funds. And then most recently, an NFT fund that will invest 30% of that client capital into kind of venture-style investments into NFT technology and companies, and then 70% in the actual collectibles and art themselves. And so I'm happy to get into more detail on any of these, but that's kind of the general overview.
Super cool. So thanks for joining. So Steve, as a professor of finance, that you've got you understand legacy capital markets, and you've got really a seat at the front, seeing what's happening in the transformation of these capital markets using this kind of technology. When you look at this market, how do you, and you see this group here, which is a bunch of nodes, okay, here. How come we don't get to be called DeFi, and why are we seen as like this group here? Why isn't this category here, which addresses huge problems of systemic friction and secondary liquidity? Why don't we get the respect from investors that DeFi, NFTs, other stuff get? Can you tell us what's wrong with us here?
So I don't think there's anything wrong. I think it is it's a difference in the rate of scaling, and so we invest across all these categories, right? We invest across regulated markets, we invest across DeFi, we invest across NFTs. I think what we've seen is that the rate of scaling of some of these decentralized protocols is astounding. We have a company in our portfolio. Last year they did $700,000 in revenue. They're going to do $1 billion in revenue this year. That sort of rate of scaling sort of doesn't happen in the presence of regulated markets. That said, I do think that, as you mentioned, the regulated markets are ultimately the biggest markets. If you look at the size of the equity markets, the bond markets, the real asset markets like real estate and others, in aggregate, that is obviously a substantial amount of value, trillions and trillions of dollars of value. And so there, we do have a thesis that in the long run, the largest companies that might get built are on the regulated side. But I think the difference is that there's just a lot more friction. It's harder to build inside of regulated environments, even though in the end it might be more defensible, there might be a deeper moat, but it's just going to take longer to sort of scale it.
Tara, your platform enables investment in lots of different things, crypto and equities. What's the breakdown? You all have the numbers. You see the activity that runs through you. Without naming names, what do your clients, the folks who leverage your service, what do they like to invest in? And can you share any trends, like from a category perspective, for given how people can leverage you?
Yeah, absolutely. But to go back on the last question, I think you just need better marketers, right, for what you're doing. This is a branding problem, it sounds like. If people understood what was going on, they wouldn't loop it in with everything else. On Alto's platform, and to put it in perspective, around this time last year, we had a little over 1,000 folks that had opened up IRAs to use them to invest into alternative assets, and about 50 million in assets under custody. We're now getting close to 700 million. So the growth has been pretty significant in a year's time. And to get to the first 50, it took close to 3 years. And what we're seeing is that there is an increasing interest in digital assets, particularly, I think, with crypto to begin, because more and more people understand that. And so we have a product that enables someone to, probably similar to John's experience, where it was a private market investment, that the investor only needed 10 minutes to do everything they would normally take 8 weeks to do. With a crypto IRA, you can open your account, you can get money in it, and you can start trading in a few minutes as well. There is a 7-day waiting period before you can make your first trade. That's the IRS, that's not us. But I think what's so exciting about it is when you think through where are some of the friction points after you've made an investment, if there is trading capabilities, it's taxes. If you get to the end of the year and you said, hey, I bought BTC at X, I sold it at Y, I bought back in again at Z, back and forth and going on, you have to figure all of this out. And whether that's crypto or any other asset that you're trading, you have to figure that out. You need to be able to file that as part of your tax return. And even if you're still fully invested and you didn't take anything take home, you're going to pay taxes on those trades. Within an IRA, this is a tax-deferred account. So any activity that occurs in that tax-deferred account, you don't have to worry about it. You only need to worry about getting money in and getting money out in retirement. Within the IRA, it's tax-deferred, and I think that's why we're seeing such of a take-up rate with the crypto IRA, because it addresses one of the biggest points of frustration for those who are investing into various coins. And then on the, I would say, traditional private market side, we see a lot of investments into venture. Everyone wants to be able to get into that next Facebook, that next Lyft, and we do support investments into private companies. So there's a big exposure to venture among our investors, as well as private equity. And then I would say the last category, we are seeing more and more securitized collectibles and art. And in fact, that's actually how I came to Alto. I was a customer before I was an employee. I found this platform called Masterworks. They will securitize high-end art like a Monet. I thought that's genius, but if I were to go out and buy a Monet, it wouldn't represent the 1% to 2% of my portfolio that they recommend, because that's $2 million is not 1% of my portfolio. And so I can invest X though. I can invest this much, and being able to go through that flow, pick my painting, and then I got to the page where it said, how do you want to pay? And radio button 1 was pay with your bank account, sync your bank account. Radio button 2 was pay with your retirement account. And that blew my mind. And it actually changed my investing decision, because I realized I don't have to figure out where this is coming from cash flow. And I think that's the exciting thing about when issuers can accept IRA capital, is it actually changes the decision-making process of their investors. Because they're no longer thinking through, okay, well, this goes up against my mortgage, my vacation, that second property that I was looking at. It's literally, this is investing capital that is meant to invest, and this is where I have my biggest bucket of funds.
So follow-up question, how many, if any, are using your service to invest as an LP into someone like Alex or Mike or Steve's firms? Is that a thing that you're starting to say? Is that a big?
Literally thousands. We support thousands of these investments every month, and the majority are as LP investments into private companies. And again, this is the benefits are clearly taxes, but it's also investing into startups. If there isn't secondary market liquidity for private assets, and I hope this room solves that because that would be awesome, but assuming that that's not the case in the immediate term, you're using an illiquid funding source, a retirement account that you can't touch until retirement, to invest into an illiquid long duration product. It matches up perfectly, and so that's one of the majority use cases.
Yeah, and I want to follow up on that liquidity thing in a minute. So, Alex, you've seen this market you've been watching this for a while. What changes, what evolution, if any, have you seen in in your investment thesis and the folks that you talk to and what folks come to you to ask about?
Yeah, so it's very interesting that we've seen the market from the beginning, right? And congratulations, you were right there at the genesis block of security tokens. Well, our central thesis was always like, are large institutional investors going to come and play in this park, or it's going to continue being like a game of people in the Silicon Valley that like technology? And together with UCLA, we've done a bunch of corporate education. Right now, we're doing a lot of work with Bank of America, and we started with the guys from BTG Pactual, which, for those of you here who have been in the industry for a while, launched one of the very first security tokens, which was a real estate asset-backed, distressed, REIT BZ. And we've seen from 2018, which is, I would say, the genesis block of security tokens, to today, an influx of institutional investors looking at how to use this and how to distribute assets to a group that they wouldn't touch before. And, you know, younger adults, millennials, and people interested in crypto. Recently, we saw the same bank, I think it was this week, BTG Pactual just announced that they're going to do a full-fledged crypto platform for all their institutional clients. For those of you who don't know BTG, they're kind of like the Goldman Sachs of Latin America. So yeah, massive institutional inflows.
Super cool. So, Mike, you all are convincing people who to deploy in, and you're making decisions to further deploy. When you're going out to raise funds from institutions or from high net worth individuals, what are their concerns? You know, are you seeing them early in the consideration cycle, or have they already made a decision by the time they talk to you that they want to be in digital assets, and they're looking for someone to walk them through? Tell what's that like?
So we started off really kind of focused on the quote-unquote crypto whales, so to speak, because they were the ones coming to us looking for that derivatives exposure, looking for access to DeFi, not just investing in tokens, but actually deploying capital into DeFi protocols and managing that process, which can be pretty laborious if you've ever dabbled in the space and are kind of grappling with the risks involved with that. And so we started off on that end of the spectrum, and then kind of thinking about how to penetrate more of the market. We made a decision, I told Tara this yesterday, that we really think that when you think about who will be the Fidelity or Vanguard of crypto, we kind of think Fidelity and Vanguard will be the Fidelity and Vanguard of crypto. So we really haven't gone to that extreme. We've thought about things in terms of where can we find informational advantage. Venture capital is obviously one of those things. If you have the right team in place and you're able to sift through the data in an efficient way. Same thing with NFTs with the team that we have in place. Les Borsey, our Chief Strategy Officer, had a full career in the music business, has a ton of connections in the space, and we really leveraged that to meet a lot of players in this space as well. We actually had a panel at SALT just last week. I think Alex was there as well, kind of going over these topics, and the reception was great. And so thinking about things in terms of active management, smart beta, which is kind of an old TradFi term, and really kind of grappling with the idea that in TradFi, I come from PIMCO and then Goldman before joining Wave, and the move towards passive management is all the trend in TradFi, but I think in this space, there is just a huge cavern for active management, and sorting through to try to find the signal and the noise in the space is really important. And so that's really what we're focused on.
Do you all invest in JPEGs?
We do.
Yeah?
Yeah. One of the things that we've done so far, at least in the NFT fund, is that we've been able to leverage some AI and tech to get into, if you look at the standard art blocks drop, they typically sell out in about 5 seconds. We've typically been able to get 5 or 6 NFTs in these drops within that 5-second window because of our size and trading capabilities. And we've typically, in that strategy, kind of identified the least rare of the NFTs that we have purchased, sold that, and so far have been fortunate enough to cover the entire cost basis of the 5 or 6 NFTs by selling the least rare vintage of that drop. And so far we've been able to kind of play with house money in the space, and but it's still pretty nascent, and we're kind of grappling with how long the fund will be open, what will it look like even 1 year from now. But super constructive and really happy so far with what we're seeing.
Alex, do you see any intersection between DeFi, NFTs, and digital asset securities? Is that coming up as a conversation yet amongst your community?
Yeah, so like I said, we speak with a lot of banks. That's kind of like our bread and butter. We just did an NFT session with Bank of America. They're looking at the space. And touching upon on the fact of DeFi, yield arbitrage is a game that has been played by some of the largest banks for the longest time. It's just that now in the DeFi space, especially in the unregulated part, that competition is going around the world to whoever is giving you the best rate. But I think that we're going to see some of these large institutions coming on the DeFi space and playing it from a regulated point of view. And interest arbitrage is huge everywhere else than in the US, because the US here leads the pack, but everybody else who's chasing the dollar would like to get that yield.
Tara, you go.
I could add something.
Yeah.
Because we invest a lot right at the intersection of DeFi and NFTs, and we also are obviously thinking about securities. Our view is that NFTs may become the largest category, and many of them will be securities, and will be regulated as securities. Because if you look around the world at just financial contracts, most financial contracts are non-fungible. The mortgage on your house is non-fungible. The insurance contract on your car is non-fungible. Your employment contract with your employer is non-fungible. All of those things are going to be wrapped as NFTs, right? As they come on chain, as more value flows move on chain, all of those contracts are going to be NFTs. And so we actually think that when you look at the spectrum of sort of financial assets on chain, which we're currently thinking about fungible assets like equity, bonds, maybe tokenized real estate, there's also going to be this huge category of non-fungible contracts that come on chain as well. And so I think that is going to end up being a huge investment category.
Tara, are folks on Alto able to invest in NFTs today?
Today, yes, but it's complicated. So I would say for 95% of folks, assume it's no. There's a lot of detail underneath that related to what custody constitutes, and ensuring that the IRA custodian, which is Alto, never loses custody of the product. What's interesting related to NFTs, I love your definition, by the way, of where the future is. I was literally like, where's my notebook? I need to write it down. Like, that's like one of the things I'm going to take away from this conference. But IRAs, there are only 3 asset types they are not allowed to invest in. There are life insurance for the beneficial owner, S-corps, hardly ever comes up, and then whole collectibles. And so that's where...
Whole collectibles.
Whole collectibles. Fractionalized, you're good, right? Like my Masterworks exam. don't ask
Help me with that.
The IRS is being very conscious of making sure you're not using your IRA in a way to directly benefit yourself, which is hilarious because it also is kind of like your own investing account. But they don't want you to go out and buy a car and call it a collectible car and park it in your garage and drive it everywhere and say, oh, but it's an investment and so I don't need to pay taxes on it, and they don't want you to go buy a whole Monet and put it up on your wall. And so that's where collectibles, this might change, but right now whole collectibles aren't okay, and so that's why.
So what do you call that? What do you call them if you don't call them collectibles?
Fractionalized is fine.
Yeah. Okay.
So as long as it's just not whole, it would be fractionalized or well, we often also use the term like the fractionalization of securitization, right?
Yeah.
And so that's where if you break it up, you're good. But if the IRS thinks that you're owning the whole thing and you're deriving benefit personally from owning
Then
it,
you owe property taxes or something? Or?
Yep.
Wow.
Yeah, it's a deep well. IRAs are a deep well. So if you have questions there, we can probably help you figure them out.
A question for the panel. Some of these assets are considered kind of gray area. There's a lot of investment going into, say, protocols where people are making equity investments into protocols, and they're getting a bonus over here in, say, pre-mined tokens and that sort of thing. When someone invests through you, are they indemnified from do they have tail risk as an LP in investment decision that you make as a GP? Like, what happens when you all you sell the liquid asset that you get as a bonus for making equity? How does that work for you all?
I could certainly talk about at the fund level. Certainly, we've kind of approached the whole industry from the standpoint of kind of embracing regulation. We're seeing right now what's happening to folks like BlockFi and Celsius, who have tried to skirt the line of calling themselves, I guess, not a security, whereas we've kind of gone the opposite direction and have fully embraced that, being an SEC registered investment advisor, so on and so forth. Unclear, I guess, at the end of the day, how the underlying assets may or may not be treated down the line. I think particularly NFTs. I would love to get your thoughts on that, Steve, actually, how NFTs could be treated down the line as underlying holdings. But for our kind of level of control and where we're focused, we think that we're kind of checking the right boxes and doing everything we can right now to kind of play by the rules and play by what we think might be some of the future rules as well. So,
are you writing insurance policies against these investments? For
No.
D&O or for any other stuff like that?
No, we take out insurance on the underlying whiskey in our whiskey fund, and
Okay.
that's the only thing I would say that's insurance related.
This is a shameless plug, I'm sorry. If you haven't met, where's Carp? Carp, you in here? Where's Dave is not here. Dave is not here. Okay, you got to check out this group called Assurely, by the way, which is insuring some of these things. Okay. What about the rest of you all? How do you see the exposure elements there?
It's interesting because when we went down the journey of trying to understand the regulatory space, which was not there yet, right? We would talk to like lawyers everywhere, Singapore, where the sandboxes were. And the general consensus, which I think is still up for today, is we don't know, we're figuring out as we go. And you would talk to lawyers everywhere, and they would have that same kind of approach. Our fund of funds is a Cayman registered fund, so we take that approach. But I think that you're going to continue to see an evolution of what is considered a security or a digital security, or how to treat, like how do you trade out of Bitcoin? You pair Bitcoin against Ethereum. You sold Bitcoin, that's a taxable event. You buy Ethereum, sell Ethereum, trade it into some DeFi coin. It's another taxable event. So I think we're going to continue to see evolution of becoming more and more regulated. To Steve's point, I think we're going to see the regulated part of this industry become larger than the unregulated part.
I agree.
Yeah.
So is there any legal liability by you as a custodian, or how do you square that?
So we are a venture-backed, self-directed IRA custodian, which all of those words going together is just, it sounds preposterous, but we actually are a trust company. So we have our own trust company charter. We think if we're not able to maintain custody, IRA custody of your assets, it's treated as a distribution. So we take our job very seriously. We work with all of the regulation that's in place. In terms of the investments being made, it is a self-directed IRA account. We're not making any sort of affirmations about what product you're investing in. We will help you find places where your Alto IRA are accepted, right? Like Masterworks is a place where your Alto IRA is accepted. Republic is a place. Bitwise, Grayscale, Pantera, Osprey, Arca. There are a lot of places where it's accepted, but we're never promoting investment product, and that's the key, because we are not an investment advisor. We're not playing that role, and so the liability on that side is simply, are we doing our job as IRA custodian to maintain custody of your account for IRS reporting purposes to ensure that you don't have any unexpected taxable events.
So you're on your site, right? You can find Osprey, you can find Arca, you can find all these other parties, but that's not considered broad solicitation.
Correct. And so since we do not have a broker-dealer registration, when you go to altoira.com, what you'll see is you'll see a list of investment partners. So these are just the public partners. There are 1,000 of private partners. The public partners have at least 2 offerings, which is what our counsel has advised us is if there are multiple opportunities with a partner, then it's not considered solicitation because the investor has to go to that partner and identify what they want to invest in. If a company is raising their own round of equity, like if Vertalo was, we couldn't list you publicly on the site as, hey, Vertalo is raising money, do you want to invest in Vertalo? Because it's a single offering and that's constituted as solicitation.
Okay, well, we'll have to figure out how we can work together on that.
Like to.
So Steve, you have so many interesting investments. How are you dealing with this issue?
So, I mean, I guess what we realize is there's varying degrees of regulatory risk in almost everything we're doing. I would say that if you're in DeFi and you are based in the US, that is probably the highest degree of risk. If you're in DeFi and you're outside of the US, we view it as lower risk. Still some regulatory risk. We think, that said, there are many assets which we know are securities, right? And will continue to be regulated as securities. There are some assets in this space we know aren't securities. Like they've pretty clearly said Bitcoin is not a security. And then there's this huge range in between, and then all of these services that are layered on top. But I guess if you just step back and if I say what is our thesis on sort of all of this stuff on how it's going to play out, the one line that we've kind of our mantra from the beginning is digital wallets will be as ubiquitous as email addresses, right? So in 1994, hardly anybody had an email address. By 2004, just about everybody had one. Everybody in this room today probably has an email address. It would be very odd not to have one. We think in 10 years that will be the situation for digital wallets. You probably will have several. You'll have maybe one through Alto. You'll have maybe one through your bank. You'll maybe have one that plugs into your web browser. You'll have one on your phone that might even come default from Apple or something like that. So the way we look at all of these things, whether it's regulated assets, unregulated assets, with varying degrees of regulatory risk, is what does the world look like when everybody has access to sort of this uniform standard of value? And because the other thing is we think across all the chains, we have positions in Ethereum, in Solana, in Avalanche, in multiple sort of layer 1 chains. We think all of this eventually gets bridged, right? There will effectively be one standard of value. And that's sort of one of the things that attracts us to projects like Vertalo is you're sort of future-proofing many of the traditional assets which make up the largest segments of value on Earth towards sort of this transition. I would say if you're in the room today, you're sort of on the bleeding edge of this transition because, I mean, as a finance professor, this is sort of the most exciting thing I've seen in my career is we are on the precipice of a large change in terms of how value pools, how it congregates, how it's deployed into assets. All of this is going to happen over the next decade. And so, yes, regulatory risk is sort of part of that because it doesn't map cleanly to these systems, right? So there are elements of regulation that are going to have to change in order for sort of like this vision to manifest. So that would be sort of my final thought on it.
Well, I've got one last question for you. It's 2021. You're starting a new company, either selling a digital asset, creating digital asset infrastructure, or maybe you're thinking about creating a custodian or some other type of regulated entity. What's the best state to establish that company in? I'll give you 3 choices: Delaware, Wyoming, or Texas.
This is a rhetorical question, right?
It's such an easy question. Okay, I'll give you this. Let's save the softball for last.
I think Texas, blockchain, Lee and them, they're up next. You want to give them that question?
Yeah, why don't we bring those guys up? Hey, hey, how'd you like this panel, folks? Did you learn something here?